Do you know what your credit score actually means? Let's dive into the world of finance and demystify this often misunderstood number. A credit score, in essence, is a numerical expression that serves as a mirror reflecting your creditworthiness. It's like a financial report card, and just as you'd want to score high in school, a high credit score is what you aim for in the financial world. But why does this matter? Well, your credit score can play a pivotal role in your financial journey. It can affect everything from the interest rates you're offered on loans and credit cards, to your ability to rent a house or apartment, and even job opportunities in some cases. Understanding your credit score and how it's calculated isn't just for financial enthusiasts. It's essential knowledge for anyone who uses or plans to use credit. So buckle up, because we're about to take a deep dive into the world of credit scores. Stay tuned to understand what factors influence your credit score. Imagine your credit score as a report card for your financial behavior. This three-digit number, ranging from 300 to 850, is a representation of your creditworthiness, or in simpler terms, your reliability as a borrower. At its core, the concept of a credit score is quite straightforward. It's a numerical summary of your credit history, and lenders use it as a tool to gauge the risk they take when they lend you money. Think of it as a numeric translation of all your past financial behavior, the good, the bad, and the ugly. Now, you might be wondering, why does it range from 300 to 850? Well, the range is set by the Fair Isaac Corporation, or FICO, which developed one of the most commonly used credit scoring models. This range exists to provide a comprehensive spectrum, where 300 represents the highest risk and 850 the lowest. So, what does it mean to have a high credit score? Well, a high credit score, say 700 or above, indicates that you're a low credit risk. It means you've consistently managed your credit well, perhaps by paying your bills on time or not maxing out your credit cards. Lenders see this and think, hey, this person is pretty responsible with their money. We can trust them. On the flip side, a low credit score, say below 600, might suggest to lenders that you're a high credit risk. This could be because of late payments, high credit card balances, or a history of defaulting on loans. In this case, lenders might think twice before lending you money, or they might charge you higher interest rates to offset the risk. Remember, your credit score isn't a static number. It can change and evolve with your financial behavior. And the good news? Even if you've made mistakes in the past, you can always work to improve your credit score and, in turn, your financial life. So, how do they calculate your credit score? Let's dive into that. There are 5 main factors that determine your credit score. First, we have payment history. This is essentially a record of whether you've paid your past credit accounts on time. It's the largest factor, making up about 35% of your total score. Late or missed payments can significantly hurt your credit score, while consistently making payments on time can help keep it healthy. Next, we have amounts owed. This refers to how much debt you have across all your credit accounts, including credit cards, mortgages, and loans. This factor makes up about 30% of your score. Having a lot of debt doesn't necessarily mean you have a low credit score, but it can if you're using a high percentage of your available credit. The third factor is the length of your credit history, which accounts for about 15% of your score. This measures how long you've had credit. Lenders like to see a long history of responsible credit use, so having older accounts can be beneficial. The fourth factor is new credit. This accounts for 10% of your score and looks at how many new accounts you've opened and how many recent inquiries lenders have made into your credit. Opening many new accounts in a short period can signal risk to lenders and can negatively impact your score. Finally, we have credit mix, which also accounts for 10% of your score. This looks at the different types of credit you have, such as credit cards, retail accounts, installment loans, mortgage loans, and more. A diverse mix of credit can show lenders that you can handle different types of credit responsibly. Each of these factors plays a unique role in determining your credit score, and understanding them can help you better manage your credit. Remember, your credit score is not a measure of your worth, but a tool that lenders use to assess risk. The better your score, the more likely you are to be approved for loans or credit at favorable terms. Now that we know how it's calculated, let's explore how to improve your credit score. Improving your credit score doesn't happen overnight, but with some discipline and patience, you can boost it. First, let's talk about timely bill payments. This may seem obvious, but paying your bills on time plays a key role in improving your credit score. Late payments can wreak havoc on your score, so make it a habit to pay all your bills before their due date. Setting up automatic payments can be a practical solution if you tend to forget due dates. Next, reducing your debt is another significant way to improve your credit score. Owing money doesn't necessarily mean you're a high-risk borrower, but owing a lot of money on numerous accounts might suggest that you are. So start chipping away at your debt, focusing on high-interest debt first. This not only improves your credit score, but also eases your financial burden. Maintaining a long credit history also contributes positively to your credit score. Lenders like to see that you've been able to manage loans over a period of time. So, think twice before closing old accounts, even if you don't use them anymore. They could be lengthening your credit history and thereby benefiting your credit score. Limiting new credit is another tip. While it might be tempting to open a new credit card at every store offering a sign-up discount, be aware that each new credit application can cause a small dip in your credit score. So think it through before you apply. Finally, maintaining a healthy credit mix can help. This means having a combination of different types of credit, such as credit cards, mortgage loans, or car loans. It shows lenders that you can handle various types of credit responsibly. These strategies require consistent effort and discipline, but the payoff is worth it. A higher credit score means better terms and lower interest rates on loans and credit cards. It's as if you've been given a financial superpower. Remember, a good credit score can open doors for you in the financial world. So why does your credit score matter? Well, think of your credit score as a report card for your financial health. It's a 3-digit number that tells lenders how trustworthy you are. The higher your credit score, the more likely you are to be approved for loans and credit cards at favorable rates. Consider this. When you apply for a loan, whether it's a mortgage or a personal loan, the lender will look at your credit score as part of their decision-making process. A good credit score can mean the difference between being approved or denied. And it's not just about approval. Your credit score can also determine the interest rate you're offered. Picture it like this. You and your friend both decide to take out a loan. You have a good credit score, but your friend's score is not so impressive. You're both approved, but you get a lower interest rate because you're seen as less of a risk. Over time, that difference in interest can add up to a significant amount. And it's not just loans. Your credit score can also impact your credit card limits. A higher credit score can lead to higher credit limits, giving you more financial flexibility. But the impact of your credit score goes beyond just loans and credit cards. It can affect your ability to rent an apartment, get a cell phone contract, or even land a job. Some employers check credit scores as part of their hiring process, particularly for jobs that involve handling money. In the long run, maintaining a good credit score can save you thousands, if not tens of thousands of dollars, by qualifying you for lower interest rates. It can open doors to opportunities and provide you with financial security. And remember, your credit score isn't set in stone. It's something you can improve over time with good financial habits. Pay your bills on time, keep your credit utilization low, and avoid taking on too much debt. In essence, your credit score is the key to your financial freedom. So, in a nutshell, a credit score is more than just a number. It's a financial barometer, giving lenders a quick, objective snapshot of your credit risk at any given point in time. It's determined by a mix of factors, including your payment history, amounts owed, length of credit history, types of credit, and new credit. However, it's not a static figure. You can improve your credit score by keeping balances low, paying on time, and only opening new credit lines when necessary. Remember, a high credit score opens up a world of financial opportunities, including lower interest rates and better terms on loans and credit cards. On the flip side, a lower score can limit these opportunities, making it more costly to borrow money. But don't fret. With a little time, effort, and financial discipline, you can improve your credit score. Remember, understanding your credit score is the first step towards managing your finances wisely.